The typical American aged 55 to 64 has accumulated roughly $134,000 toward retirement. That figure comes directly from the Federal Reserve's own data in the 2022 Survey of Consumer Finances. And here is the dimension nobody brings up. A considerable portion of the individuals in that number have been putting money into a retirement account for 20-plus years, carry a loose strategy, and characterize themselves as fairly disciplined with finances. The four issues I am about to reveal are not personality defects. They are structural forces that operate quietly beneath the surface, compounding in the unfavorable direction, while everything on top resembles ordinary grown-up financial conduct. And two of them genuinely intensify the higher your earnings climb. That is what renders them costly, and that is what renders them deserving of your complete focus right now. Here is what this video truly addresses. Not willpower, not inspiration. I am going to demonstrate the arithmetic, the behavioral science, and in one instance, the particular industry framework that is constructed intentionally with purpose to guarantee you never observe the total expense. Because these four indicators are not separate issues, they create a sealed circuit. Once you recognize how they interrelate, the entire apparatus becomes apparent in a manner that is authentically illuminating and irritating, but primarily illuminating. Incidentally, I developed a complementary early retirement calculator because most digital ones are mathematically flawed. They disregard fee erosion, behavioral loss consequences, and sequence of returns danger, which are the three elements that genuinely dictate results. It employs BlackRock and Vanguard's own analytical structures to locate the vulnerable spots in your strategy, and I solely request your email to deliver the report, so I do not retain any of your financial information. Link is in the description. Now, here is the foundational concept to retain in your thoughts throughout this complete video. Envision a speedboat with 4 anchors trailing behind it. Not massive anchors, modest ones, perhaps 40 pounds apiece. Separately, none of them halts the vessel, but all 4 combined at maximum throttle, you are consuming fuel, generating turbulence, and advancing at approximately 1/3 of your achievable velocity. And here is what strikes me about this picture. The vessel still seems like it is progressing. You sense the motor. You sense the breeze. Nothing declares itself as devastatingly broken. That is the psychology of gradual financial decline. It does not register as decline. It registers as advancement that is somewhat slower than you would prefer. Each of the 4 indicators is one of those anchors, and the rationale I label them indicators instead of errors is that every last one of them from the interior resembles a conscientious grown-up financial choice. That is the snare. In several minutes, I am going to present the 3rd indicator, which is where intelligent individuals get stumbled the most. But first, here is the indicator that finance creators nearly always characterize incorrectly because they pinpoint the symptom and overlook the mechanism completely. Indicator number 1, your savings rate has never genuinely increased. Not your savings total, your savings rate, the proportion of gross monthly earnings that transfers into wealth-accumulating instruments. And here is the disquieting truth. For the majority of individuals in their late 30s and 40s, this figure is virtually unchanged from what it was in their mid-20s. Earnings have climbed. Lifestyle has climbed. The distance between them, the genuine propellant for compounding, has remained constant. There is an account that illustrates this more accurately than any theoretical number. There is a man, we will name him David, 41 years old, project manager at a shipping firm in Columbus, Ohio. In 2014, he was 30, earning $58,000 annually, setting aside approximately 6%, roughly $3,500 each year. Currently, he earns $95,000. His savings rate remains 6%. When his earnings jumped at 33, he leased a nicer vehicle. At 36, he relocated to a bigger apartment. At 38, he and his spouse purchased a house with a mortgage that seemed suitable for their earnings. None of those choices appeared irresponsible. Each one was proportional to where he stood in life. That is the mechanism, not lavishness, recalibration. The mind perpetually revises what standard appears like according to accessible earnings, and standard devours earnings. This is lifestyle creep. But I want to be exact about what renders it expensive. It is not recklessness. David does not sense he is overspending. He senses he is existing appropriately for a 41-year-old making $95,000. He is, and that sensation is depleting him of $400,000 and compounding across the following 2 decades. There is a behavioral economics principle worth grasping here termed positional consumption. Robert Frank at Cornell has examined this for decades. The conclusion: as earnings climb, the peer comparison group individuals measure their lifestyle against climbs in tandem. David in Columbus is not weighing his present lifestyle against what he required at 30. He is weighing it against what his coworkers and neighbors possess at 41. Their lifestyle has expanded at roughly the identical pace his has. The standard shifted. He matched it. The savings rate did not move. Now here is the inversion that this entire indicator is genuinely about. You believe the issue is that you must earn more. Every finance creator concurs with you. Secure a promotion, launch a secondary venture, push harder. Greater earnings is the answer. But here is what the evidence reveals. American median household earnings adjusted for inflation expanded by approximately 30% between 1995 and 2022. Median retirement savings at conventional retirement age also approximately 30% beyond where they stood in the equivalent time frame in real terms. The earnings expanded. The wealth did not disproportionately follow because the mechanism for transforming earnings into wealth. The savings rate never shifted. The issue was never earnings. It was perpetually allocation proportion. I conceptualize the journey from nothing to substantial wealth in 3 stages. Stage 1 is foundation, elevating your savings rate to 20% of gross and sustaining it there sufficiently long to construct a significant base. Stage 2 is ignition, the juncture where your current portfolio produces annual gains that compete with your annual deposits. So, the engine is partially powering itself. Stage 3 is breakaway speed. When your portfolio expands in a strong week beyond what you collect in a month, and your employment earnings become secondary to your capital's earnings, most individuals never depart stage 1. Not because they cannot produce the earnings to finance stage 2, but because the lifestyle recalibration issue keeps resetting the savings rate before the foundation grows sufficiently large. The arithmetic here is not nuanced. You earn $80,000 annually. At 6% savings, $4,800 yearly invested, at 7% average yearly return over 20 years, you amass roughly $197,000. Not terrible. But at 20% savings, $16,000 yearly, identical 7% return, identical 20 years, you amass $656,000. 3 times the savings rate generates more than 3 times the wealth. That is the compounding amplifier. It does not care about your emotions regarding it. The structural remedy is not inspirational. You automate the transfer to your investment account before any other expenditure is addressed. Not following bills, not from what remains first. The investment deposit is the non-negotiable boundary, and your lifestyle conforms around it. Most individuals do the opposite. Handle lifestyle as unchangeable and investment deposits as whatever is left over. Reversing that single architectural choice alters the 20-year projection by multiple 100,000. You are still pulling the anchor. Now, remain with me because the following one is where the industry authentically collects its revenue, and I intend that in the most direct sense imaginable. Indicator number 2, you are paying charges you have never truly tallied up. This is not the standard fees are harmful lecture. I want to provide you the actual figure, explain to you precisely where the charges conceal themselves, and clarify why the concealment is the intentional business framework. Begin with fund expense ratios. You have $200,000 invested. Fund A levies 1% yearly in total expense ratios. This is a standard actively managed mutual fund, which is what millions of Americans are automatically placed into in employer retirement plans. Fund B levies 0.07% of Vanguard or Fidelity Total Market Index Fund. The yearly gap appears trivial, roughly $1,960, over 30 years at a 7% gross return. Fund A expands your $200,000 to $148,000. Fund B expands it to $1,522,000. The variance is $374,000 surrendered as a charge to a product that, according to the S&P SPIVA report, which evaluates active fund results against their standards twice yearly, trails the index in greater than 80% of instances over 15-year spans. You surrendered $374,000 for something with under a 20% likelihood of being worth what you surrendered for it. Incidentally, press subscribe if you appreciate the material, otherwise the platform's algorithm may never display my content again. I produce these videos to develop the platform, and subscriptions are the genuine mechanism that makes this function. The second tier of charges is advisor expense. A financial consultant charging 1% AUM on a $500,000 portfolio charges $5,000 annually. That figure escalates as the portfolio escalates over 20 years, factoring in the compounding those dollars would otherwise produce at 7%. You are not paying $100,000. You are paying roughly $330,000. That is what departs your long-term wealth, because every charge dollar ceases compounding from the instant it exits. $330,000 for counsel that in most uncomplicated long-term investing scenarios comprises keeping you in a diversified low-expense allocation and persuading you not to sell during crashes. Both of those functions carry authentic worth. The inquiry is whether that worth justifies $330,000 throughout your investing duration. For individuals with elaborate tax circumstances, estate planning requirements, or corporate structures, the equation can function. For most individuals, investing in tax-sheltered accounts toward a conventional retirement. It does not. There is a third tier nearly nobody addresses: the target date fund snare inside employer retirement plans. Target date funds are the automatic enrollment selection in most 401k plans. They systematically adjust the allocation as you near a designated retirement year, which appears practical and typically is, but the average expense ratio on a target date fund is roughly 0.35%. And numerous ones contain other funds within them, a fund of funds arrangement where you are paying expenses at dual levels. The index fund equivalent in your identical plan might charge 0.04%. On a $200,000 401k, the variance between 0.35 and 0.04 over 20 years at 7% is roughly $60,000. For a rebalancing system, you could duplicate yourself in 3 transactions per year. There is additionally cash drag. Actively managed funds ordinarily maintain between 2 and 5% of their holdings in cash as a liquidity reserve for withdrawals. That cash remains dormant, not compounding, while you still pay the complete expense ratio on it. On $200,000, a 5% cash reserve at 7% opportunity cost is $700 annually. In compounding, you are not receiving, it accumulates every year silently, never surfacing as a line entry on your statement. The rationale these charges are arranged this way is not conspiracy. It is behavioral economics. A 1% yearly charge deducted automatically registers nothing like composing a check for $374,000 at age 65. A quarterly report that reads, expense ratio 0.85%, registers quite differently from an invoice that states charge for services provided $400,000. The complete industry is erected on the psychological separation between the recurring deduction and the lifetime expense. Eliminating that separation, genuinely computing the lifetime expense of every financial instrument you possess is one of the single greatest return activities you can perform in an afternoon. Now, let me present you to Marcus because his account threads through the remainder of this video, and it is going to solidify something particular for you. Marcus is 42, senior accountant at a healthcare firm in Phoenix. He has been there 13 years, earns $86,000 annually, and signed up for his 401k when he began. He deposits 4%, employer contributes 3%. He has never modified his allocation from what human resources defaulted him into, a cautious target date fund that operates roughly 60% bonds, 35% domestic stocks, and 5% cash equivalents. That portfolio has averaged roughly 4% yearly over the preceding 13 years. If Marcus had been in the plan's S&P 500 index selection, which his plan provides, and which averaged roughly 10% over the identical duration, his total would be substantially greater. He is unaware of this. He has never examined the allocation display. He enrolled and continued onward. I am returning to Marcus at the conclusion of this video. He carries a fifth concern that connects all 4 indicators together. And when I demonstrate what it is, I suspect you will identify it in your personal circumstances. This is where it becomes genuinely fascinating because indicator number 3 is the one that causes educated, analytical individuals, The greatest defensiveness because they are persuaded it does not pertain to them. Indicator number 3. Your conduct during declines cost you more than the declines themselves. Dalbar, the financial analysis organization, has been monitoring the disparity between what markets deliver and what investors genuinely receive for over 30 years. Their examination of the 20-year interval concluding December 2022 reveals the S&P 500 delivered 9.65% yearly. The typical equity fund investor collected roughly 6.81%, a disparity of almost 3 percentage points annually. That is completely accounted for by one factor. Individuals shifted their capital at the incorrect moments. Project that disparity ahead. $200,000 at 9.65% for 20 years expands to $258,000. At 6.81%, it expands to $730,000. The disparity is $528,000. You did not forfeit that in a downturn. You forfeited it in a sequence of entirely logical, emotionally rational reactions to uneasy situations. You shifted to bonds when markets appeared menacing. You hesitated to reinvest until conditions normalized. You re-entered after the rebound was already substantially progressing. You paid double, once for the departure cost, once for missing the recovery. The psychological mechanism is recorded and exact. Kahneman and Tversky's prospect theory, published in 1979, demonstrated that losses register roughly 2 to 2.5 times more acutely than comparable gains register pleasurably. A 20% portfolio decrease does not feel as poor. It feels as catastrophically, disproportionately awful compared to the 20% increase you celebrated when conditions were favorable. Your mind did not develop for extended-term equity investing. It developed for immediate threat reaction. A shrinking portfolio activates that reaction. The behavior that alleviates the threat is shifting to safety. The behavior that optimizes long-term gains is remaining motionless. These two imperatives are in absolute opposition every single occasion. There is a pullback. There is an internal fidelity examination that gets referenced in behavioral finance discussions. And while the source document is challenging to locate precisely, the conclusion aligns with wider research. Some of the strongest performing accounts at Fidelity belong to investors who had either neglected the account completely or were deceased. Not because passivity is a genius approach, because activity when propelled by emotional reaction to market circumstances is consistently more costly than passivity. The approach was correct. The conduct undermined it. There is a variation of this issue that is even more costly and receives virtually no discussion. Opportunity cost immobilization. Individuals who are endlessly awaiting a superior entry moment. I have encountered investors who have been declaring this since 2017. The S&P 500 from 2017 to 2024 delivered roughly 140% in aggregate. Every month spent anticipating the market to retreat before investing was a month of that 140% they failed to capture. The market timing cemetery is populated with individuals who were directionally accurate. Yes, retreats occur and devastatingly mistaken about timing. Being mistaken about timing in a compounding setting is more destructive than being mistaken about direction, because the clock never ceases running in either scenario. There is additionally a third variation particular to individuals nearing retirement age: sequence of returns danger. If you encounter substantial portfolio declines in the years directly preceding or following your withdrawal commencement, say ages 58 to 65, those declines are fundamentally more damaging than declines earlier in your profession because you do not possess 20 additional years of deposits to average them out. This is why emotional conduct amplifies with age. The nearer you are to requiring the capital, the more a decline registers as a legitimate crisis, and the greater the fundamental damage if you react to it by converting to cash. The resolution is not to de-risk into cash as you approach retirement. It is to establish a liquidity cushion 1 to 2 years of anticipated expenditures in a high-yield savings account so that a market correction never compels you to liquidate at the trough to finance your existence. Someone previously informed me they had been actively overseeing their own portfolio since 2001. I investigate every holding, they stated. I examine the charts every morning. They had averaged 5.2% yearly over 23 years. The S&P 500 averaged roughly 9.8% over the equivalent duration. That morning routine cost them 4.6 percentage points annually for 23 years. Engaged, meticulous, research-guided investing performed with emotional sensitivity to daily market conditions is more costly than possessing a mundane index fund and never examining it. The detachment protocol is straightforward. Your investment account is not a portfolio you oversee. It is a machine you supply on a predetermined schedule, automatic deposits, established calendar regardless of what markets are experiencing. No reviewing performance during disruptions. One yearly 30-minute allocation assessment. That protocol, executed mechanically, is valued at roughly $500,000 on $200,000 in initial capital over 20 years, based on the genuine behavior disparity Dalbar has recorded. You are still pulling the anchor. Now, here is what nobody is communicating to you about the fourth indicator. It is the one that renders the other three worse. Not in a symbolic manner, mechanically, fundamentally worse. Indicator number 4. You have never possessed an asset that produces while you rest. This is the framework of the entire issue, and it extends deeper than investment choice into something nearer to financial self-concept. There are two varieties of wealth accumulation reliance. Variety 1, your wealth expands solely when you labor. Your effort is the exclusive motor. If you cease laboring, growth halts. Your complete financial destiny depends on one asset, your sustained, unbroken, healthy participation in an employment market. Variety 2, your wealth expands regardless of whether you appear because you hold assets that yield returns detached from your exertion. Dividend-distributing index funds, revenue-producing real estate, enterprise equity, interest-generating instruments, any return-producing asset that operates a rotation you did not perform. Most Americans, including substantial earners collecting six figures, are Variety 1 investors. Their financial existences contain zero backup. The Federal Reserve's information on this is sobering. The typical 35-year-old in the United States holds a net worth of roughly $76,000. A meaningful share of that is housing equity, which is a leveraged holding, beneficial for steadiness, inferior as a growth generator in most circumstances, and entirely illiquid unless you dispose or refinance. The share of that net worth that is genuinely in return producing financial holdings, equities, funds, bonds for the median 35-year-old is nearer to $25,000. $25,000 at 7% produces $1,750 in passive yearly expansion. That is not a secondary motor. That is ambient noise on a paycheck. Let me present you a condensed case study with actual figures. Take someone I will name Jennifer, 43, marketing director in Seattle, gross earnings of $115,000. She maintains a 401k containing $84,000, a high-yield savings account holding $22,000, and no additional investments. Total investable holdings, $106,000. She has technically surpassed the $100,000 benchmark. But here is what her capital is genuinely accomplishing. The 401k in a conventional 60-40 distribution produces roughly 5.5% yearly. The savings account delivers approximately 4.6% in early 2026 interest rate conditions. Her combined return on aggregate holdings is approximately 5%, producing roughly $5,300 annually in passive expansion after tax on the savings account interest nearer to $4,000. That is her secondary motor. $4,000 annually on $106,000 of capital, roughly 3.5% of her monthly earnings. Her capital is performing a courtesy, not a function. What transforms if Jennifer executes one fundamental choice? Same $106,000 redirected $80,000 into a total market index fund within her 401k, $26,000 into a taxable investment account in a low-expense S&P 500 ETF at 0.03% expense ratio. Presuming an 8% average yearly return, the conservative boundary of what index funds have historically produced after inflation modifications versus the existing 5%. The variance on that $106,000 over 15 years with no further deposits is roughly $140,000. Not from laboring intensely, not from collecting more. From one afternoon of choices about where the capital currently resides. Jennifer's position is not poor, It is above typical. She possesses six figures in investable holdings at 43. The difficulty is she is producing 60% of the gains she could be, and she has never rendered a deliberate choice to alter it because nobody has ever presented her that particular computation. Now, here is the segment that genuinely clarifies why the Variety 2 shift does not materialize for most individuals, even when the opportunity exists. In early 2026, you can establish a Vanguard account in fewer than 10 minutes, invest $1, and maintain fractional stakes in over 3,500 enterprises worldwide through a single ETF. The framework is complementary. The minimum is essentially nothing. The historical gain of the total market index is documented across 90-plus years. The accessibility challenge has been resolved. The self-concept challenge has not. There is a profoundly rooted cultural formula in American society between labor and morality. Earned wages feel legitimate in a manner passive returns do not. I have observed individuals spend dividend disbursements they would never spend the comparable paycheck on because the dividend does not register as earned identically. So, it does not register as genuine capital. I have observed individuals postpone establishing brokerage accounts because investing appears complex when the genuine complexity is roughly 20 minutes of configuration. And I have observed individuals who have surpassed $100,000 in holdings approach it as something to cautiously safeguard rather than a framework to methodically expand, because proprietor is a distinct self-concept than provider, and self-concept transitions are uncomfortable in manners that are simple to miscalculate. I have been deploying my personal capital for over a decade. Multiple hundreds of thousands of dollars, genuine capital with genuine consequences, operating enterprises, collaborating alongside accountants and financial attorneys who contemplate money structurally every day. The instant I ceased conceptualizing my investment portfolio as a savings repository I was accountable for and commenced conceptualizing it as a labor force, I was directing individuals I was employing who operated rotations I did not, my connection to every financial choice transformed. It ceased being about deprivation and commenced being about allocation. Where does the subsequent dollar perform optimally? That cognitive restructuring is valued more than any particular fund selection you will ever render. An investor previously shared with me he had been too frightened to place capital in the market since 2008. He mentioned he had been monitoring the S&P 500 attentively the entire duration, awaiting the ideal occasion. The S&P 500 delivered approximately 500% from the market trough in March 2009 to the conclusion of 2023. He observed all 500% from the periphery. That is not a cautionary tale about markets. That is a tale about what the yield on apprehension genuinely is. You are still pulling the anchor. Now, let me conclude Marcus's account because I committed I would, and because it achieves something the case analyses cannot accomplish. It demonstrates what the aggregate burden of all four indicators resembles in a solitary actual progression. Marcus at 42 carries all four anchors. Savings rate of 7% that has never shifted in 13 years. A cautious default distribution returning 4%. He has never examined his expense ratios, and he has never deliberately selected to possess an asset refined for long-term expansion. He possesses what human resources enrolled him in a decade prior without revising it once. Projecting ahead 20 years to age 62. On his present course, depositing 7% at 4% return, he accumulates roughly $325,000 by retirement. If Marcus implements 4 modifications this month, elevates his deposit to 15%, transitions to the plan's index selection at 0.04% expense ratio, establishes an automatic $250 monthly deposit to a taxable brokerage in a total market ETF, and deletes his investing applications from his phone so he cannot respond emotionally during turbulence. His estimated total at 62 is roughly $150,000 spanning both accounts, presuming an 8% average return, identical earnings, identical city, identical position. 4 structural choices at age 42. The disparity between those two versions of Marcus, $325,000 versus $150,000, is not a disparity in intellect, exertion, or earnings. It is 4 anchors he severed versus 4 anchors he continued dragging. 3 actions to complete this week, particularly this week, not some theoretical future moment. First, determine your genuine savings rate right now, not your approximation. Access the previous 3 months of bank records. Pinpoint every dollar that transferred into a retirement or investment account. Divide by your gross earnings across the identical duration.